I've loved listening to Drew talk because I think, his message, if you boil it down, really is, it's all about interest rates, dummy. We are in a time period here where, we're at an inflection point. And I think the issue is, when does it turn? And that's what everybody's been worrying about. As he mentioned earlier, that's why the stock market kind of got the shakes when somebody said the caffeine was going away. And, it is going to go away at some point. I think the thing that I puzzle over is, as you listen to his story, that buyer is the Federal Reserve. And if you look at the Federal Reserve's balance sheet, you ought to do it. You can go home, you can look at it online. Federal Reserve over the last couple of years has ballooned up from about $700 billion in assets to $3 trillion. So while they've been buying, they own a bunch of that stuff that, as Drew says, is going to go down in value. So as interest rates go up. So how does the Federal Reserve, and I think that's the conundrum that a lot of people around the country are wondering about. How does the cure's been great because it kept us from going through a lot of pain that the disease brought with it, but it's still unclear how the Federal Reserve gets itself out of this mess. So I'm going to kick off and go to something totally different, but it's sort of a tie-in to some of the things I've told you in the past, because one of the things Bill wanted me to talk about was what's going on with the banks and credit markets, and all of this stuff, again, is tied together. Remember, I always tell people, when we had the crash, all of a sudden people had heard of Hyman Minsky, and I've spoken several times about Minsky, and if you haven't gone back and looked at Minsky, and you ought to, because as I've said, Minsky talks about this credit cycle that we went through, and it was very real. We went through traditional banking as hedge lending, where bankers come in and they're very careful, and they've got collateral, and they've got good character, and they've got a personal guarantee, and they make very safe loans. And then as the economy heats up in progressive, bankers are like anybody else. It's a competitive market. They get a little bit more speculative in the loans that they make. And we moved to a little bit more speculative lending. And then when the economy gets really heated up, bankers are loaning against the future, and people are buying assets with borrowed money on the bet that there's a bigger fool down the road somewhere. And of course, we all know that's where we were with real estate when the crash came. And then as he said, what happens when the crash comes, which it did, then all of a sudden the bankers snap right back to hedge lending, where all of a sudden, credit quality is essential, underwriting is really tight. So just in the point in time when the Federal Reserve's pumping, potential money into the system, so that the bankers can loan that money and create money, loan the reserves that the Federal Reserve gave them. The bankers could loan those reserves out and create money. Well, the bankers aren't making loans because they've got regulators beating down on them. And after all, they just learned their lesson about making speculative loans. And so we went through a period right after the crash where, I was coming in here saying, the banks aren't lending money, we're not going to get deals done, it's a pretty tough time. Well, I can tell you today, I think things are a little bit better. So, we'll kind of segue into how all of that fits in with what's going on at GulfStar, because we're in the private markets. But we're small relative to the public markets overall if you look at the secondary trading. But as I'm going to show you, the private markets have become very, very important for the United States in terms of providing new capital, and I'm talking about primary dollars, new money coming into companies, as opposed to all the secondary trades that go on in the public markets. So, first I want to talk to you about the middle market, because at GulfStar, we don't, I guess we finally are old enough where we can brag a little bit. I think, we can safely say, we are the premier middle market investment bank here in the Southwest, focusing on the M&A market. And of course, the question is, middle market, why is the middle market important? If you look at it, I think what's significant to us is, if you look at the value of middle market deals in the M&A market, it's only 25%, but they're usually 80 to 90% of the total deals that get done every year. And so the M&A market very much is about the middle market and the companies and the entrepreneurs in that market. If we look at how the M&A activity's been going on in the oil field, here you can see, pre-crash and post-crash numbers. Our industry was clobbered. We were the tip of the whip. We had a bunch of deals on the table in late 2008, and they all evaporated when the crash came. And you can see 2009 was pretty tough. This is oil field services. We've always been very active in oil field services. And one of the things that we've discovered in the last couple of years is that after 20-something, or actually since the 80s, after 30 or so years of worrying about getting our economy diversified, Houston finally is diversified. This year we have very solid upstream, midstream, and downstream business. Okay. And we're glad of it. So, here's the oil field services space, and you can see a lot of this is also shale play related, but there's a big story about our economy, and this is the interesting story about how does the interest rate story play out against the energy story that's playing out, because the energy story is a story around can we really take advantage of cheap domestic energy to get this engine of the U.S. economy really fired up and competitive. Because if we can, maybe we will be able to pay off the debt someday, but I think that's the issue. If we flip to this next one, here's the midstream, and of course you're going to see in this data, you see some big deals coming in particular years, but you see the activity in the midstream. We're seeing the activity in the midstream picking up. One of the things that's happened a little bit, you saw the midstream, the pipeline projects didn't get turned off the way the drill bit got turned off. And so those projects continued a little bit after the crash. But then 12 was a little bit slow for the pipelines, but 14, 15, the pipelines have a tremendous volume of projects on the table, which means that the pipeline service companies and contractors and the people that are providing the goods into that sector are going to be doing very well, and you see people kind of anticipating that, teeing up with the volume. Because one of the things that we see is private equity tries to anticipate. They're always trying to skate out in front of the puck. So where's the economy going? Where's a growth area going to be? They're trying to get ahead of it and get positioned so that they benefit from the uptick when it does come. Here's the downstream, and you can see, the downstream not quite as big a space as the other two spaces. And, there's a couple of recent deals announced in the downstream this year. So I think that slide probably not quite representative of where we are in the downstream. And I know from the phone calls that we get, there's very much private equity interest in the downstream energy services space right now also. So, our metrics, what do we look at? And this is the big thing that people are always asking us about. What are companies selling for? And if you don't work in the M&A world, you probably think that if people start talking about EBITDA, it's maybe a quote from Andy Kaufman or something, but we're always talking about earnings before interest, taxes, and depreciation and amortization. So we're talking about multiples of the cash flow profit that a business earns. And what you can see here is, in 2012, middle market companies, and this comes from a data source we use, GF Data, but middle market companies were actually back up and trading above the multiples that they traded at before the crash. Part of that is interest rates, because money is cheap right now. And we all know that multiples are the inverse of the discount rate. So you got cheap money, you're going to have higher multiples. But what we see here is multiples for companies are every bit as good as they were pre-crash. And then if we kind of segment the market, because we think this makes a difference also, because a lot of times when we talk to business owners, they may have heard what somebody else's business sells for, but we know that in the marketplace, it's very hard to compare companies because you don't know about growth rates, you don't know about returns on capital, you don't know about size, and size really makes a difference because this is a marketplace that's relatively segmented. As I'll show you a little bit later, the private equity funds vary by the amount of capital that they have under management. Well, the more capital that they have in a fund, the larger the companies they have to invest in because they're only going to buy a certain number of companies. They're going to write a certain check size. And so given the amount of money that they actually have in the fund, that's going to affect the size check they have to write and therefore the size companies they're interested in. So, we consistently see that smaller companies are going to sell at a lower multiple than larger companies. Which interestingly is some of the stuff even in the public markets. There's a size factor in the public markets. So there's another part of it that says to me it's not at all illogical or inconsistent. Now here's the point that I was making a little bit earlier, and I don't know because this is early data for 2013, but one of the things you see here, we look at debt multiples because everything again tracks back to EBITDA levels. So what are the lenders doing? How much money are they willing to lend to a company based on EBITDA that the company has. And so you can see here, 2008, which has data primarily before the crash. They weren't doing a lot of lending in the last quarter of '08, as I recall. Not a lot of deals were closing. So this is probably a pretty good pre-crash number. 3.3 times total debt, and you can see 2.3 of that coming in senior debt and 1 turn coming in sub-debt. And one of the things that we see is that the sub-debt marketplace is always, that's the place people go to sort of fill in the open slot in the capital structure. And we'll see in a minute, private equity typically is putting about $1 in for every dollar of debt that they raise to buy a company. So if the banks aren't willing to match them dollar for dollar, then they're going to the sub-debt market. So what we see is that more recently, the banks have been willing to put in more senior debt, and along with that, they're still using sub-debt, but it's a little bit less in the sub-debt in the capital structure than previously. So if you take a look at this one, this is looking at, what are the capital structures, and this comes from GF also, but this is, what do the capital structures look like? And you'll see 2009, right after the crash, you'll see the equity percentages had to go up dramatically, and they're still using a lot of sub-debt, because in 2009, they're only getting about 30 cents on the dollar in the cap structure from the banks, senior debt. But we've recovered from that. You move fast forward, look at 11, 12, and where we are in 13, we're back to private equity putting in about 47 cents of every dollar. But more recently, we've seen the banks putting more money into these transactions, and therefore the sub-debt portion in the cap structure getting pushed down a little bit. So what do you take away from this? I think, again, what you take away is low interest rates, availability of capital. The marketplace for these assets is going to be pretty robust for a period of time here, and that's really what we're starting to see, this marketplace coming back. If we go to the next slide, and this one I think, and we'll pull a little bit on this later on, but you can see everybody was talking in '06 and '07, this market was overheated. And you look at the number of deals, and you look at the number, the total capital deployed. 2006, private equity put out $500 billion. In 2007, they put out almost $850 billion. You look at the deal count, private equity market was just blowing and going until the brakes got put on. And then you can see '08 was much slower because they started backing off. I mean, I can remember we had people backing out of deals as early as the summer of '08 because they began to be concerned about where the economy was going. So they were adjusting even before the crash came. You see 2009, which is sort of a low. And then the other thing that I encourage you to look at, I think the industry's kind of, at least the last 3 years, it's interesting that it's kind of stabilized, a little over 2,000 deals a year, putting out somewhere, 350 billion plus or minus. But keep that $350 billion number in mind because we'll come back to it a little bit later on. And then the upper section there, you can see, they deployed about as much capital in the first half of this year, but fewer deals. Because there's a lot of talk around, people, discussion about is the deal market really slowing down. I'd have to say it was slow in the first quarter, but we've really seen our volume of activity pick up since the first quarter, and because of the way our business runs, you'll see those closings begin to happen late in the third quarter and in the fourth quarter and on into the first quarter of next year. So from our window, it looks like there's a lot of activity that's teed up. There's a lot of capital coming into private companies now and through the end of the year. This goes again and looks at slightly looking at halves of the years, just kind of break it around. So it's the same kind of data, but just looking at halves of the years. But one of the things I wanted to point out to you, back to getting some, kind of a fix on the level of activity, you can see that the number of deals, although the dollars were bigger, the number of deals that were closed in the first half of this year were about the same as the number of deals closed in the two halves of 2009. So from the perspective of the number of deals that are closing, yeah, the deal count is down, but interestingly, they're putting out, they're on track probably, I think they're on track to do around $350 billion again this year. This looks at similar kind of data, but now, we're looking at giving you a little bit of more of a historical view, because I think a historical view is really important, because especially when Congress starts talking about, messing with what private equity funds are doing and trying to make it harder for them to do business, I think most people on Main Street don't understand how this industry has really changed the way capital flows into private companies to allow them to become really big companies. And I'll never forget my favorite idiot reporter quote. I hope there are no reporters in here. I sometimes find it very hard to listen to the economic questions that reporters ask. But my favorite one is someone was asking a business person, well, how can you have profits and create jobs at the same time? And I went, what? But the concept was that, well, you get rid of jobs so that the stockholders make more profit. And so to have more profit, you have fewer jobs. And I'm going, where in the world did you study anything about economics? Because clearly, if we put money, and because we all know, if you look at the studies from the Kauffman Foundation, private companies, newer companies are the job creators. The big companies, yeah, they create jobs, but on a net basis, not so much. The job creation is going to come from private companies, small companies growing, and that ain't going to happen if they don't get capital. So this is what I think, here's the remarkable story. Because the remarkable story is look at the capital that's come into the marketplace through private equity. Okay? This is the deal count. This is what they're doing in the economy. This is the amount of capital that they have under management. So you go back to 1997, or if you want, go back to 1993. Let's just go back 20 years. Okay? $3 billion is all they put into the economy. New capital, 20 years ago from private equity, $3 billion. Okay? 360 billion, 358 billion last year. Okay? That's over a 20-year span. Don't tell me that's not having an impact on the potential of this economy to grow and to adjust to things like having cheap natural gas that can, have you ever looked at an input matrix to see where energy goes? Every final product in the economy consumes an incredible amount of energy. I mean, even a refinery, the number one cost of goods at a refinery, we all know, it's oil. It's the raw crude that they put in. What do you think the number two cost is? Electricity. That's why when you drive through Deer Park and you see that cogen plant says Calpine up at the front of that refinery, because they consume tremendous amount of electricity to run that plant. So energy, but you need capital. There's a big infrastructure shift going on. Private equity is trying to play a role in helping that infrastructure shift happen. And then here's just the other piece of it. I mean, here is, the number of private equity firms that are out there, and the lighter shade is the new firms that are coming into the marketplace. The others existing. I misquoted this a little bit last time. I thought it was a few more. But we're almost 5,000 private equity firms today. And that's coming from just a couple hundred, or maybe not even 100 back in 1993. So this really is a nascent industry, but people don't understand. I used to make my students read a book by Vincent Carasso talking about the investment banking industry, and the big story was how in America we innovated the way underwritings were done at the turn of the century. And that's why we had this great big merger wave at the end of the 19th century going into the early 1900s. Well, this is, I think, the innovation in American finance in the latter part of the 20th century. And I think, it's got real legs today. Back to what Drew's saying, more and more people, if you're looking at the marketplace today saying, gosh, I got to find a place to put money that's not exposed to the whims of the public marketplace. I need to invest wholesale rather than retail. Well, that's what private equity is for a lot of people. This is the one that we track a lot. This is what we look at the overhang, how much, this is the portfolio companies that the private equity companies actually have. So this is sort of the cumulative effect of them buying companies, because they don't buy them and hold them. They may have different hold periods, but at some point they're going to spin them out. They may take them public. They may sell them to somebody else. But here we see private equity firms have almost 7,000 portfolio companies today. Those are companies that are all going to be sold at some point. Sold or taken public. And then the other thing we look at, these portfolios that have been in the portfolio a longer period of time, those that went in basically 2008 or earlier, those are the ones that are sort of reaching sort of the end of the normal hold period. And you can see that that's almost a little bit more than half of the companies that they own. So there's going to be a continuing active M&A market also for the private equity guys just to rotate their portfolios. And then here's the other one that we look at. This is, where does the money sit? Who's got the money to invest? Because if we look at it, private equity is always raising new money and putting it to work. one of the things we see is that 2008, because there'd been such a boom in fundraising, they were sitting on about $473 billion in dry powder, which is money they've got available to put into the economy. That, you can see, has come down. Part of that is not so much the rate of deployment, but it's the rate of fundraising. Because you saw that earlier slide, they've been putting money to work pretty actively. But there was a big slowdown in fundraising right after the crash. But then the other thing that we look at is this bottom end of the stack. These are dollars in older funds that if those dollars don't get deployed, those dollars will never get called. Because the way private equity works, you don't get the money right away. You call the money as you have a company to invest it in. Well, if you get to the end of the period during which you're making investment and you haven't called all the money, you just don't get it. So there's an incentive, not to say that it's an adverse incentive, but there's an incentive for private equity to make sure that money goes to work. But this is something that's important to us, and I apologize for all the numbers. I'm going to give you the quick summary. The reason I put this table together is that when you segment them, you'll see that the funds that are $1 billion and under, which are typically the funds that we see investing in middle market companies, if you add them together, they're only $87.4 billion out of that $328 billion. So the total number is not as reflective as what's really available for the middle market. But I think at the same time, that's plenty of money to keep us busy. And then here, I'm just giving you another look at that in terms of by the vintage year of the funds. And showing you that we really did kind of we have sort of this hump here because we have some of the older money. Then we have the period after the crash where private equity wasn't raising nearly as much money, but then fundraising has gotten really active again in the last couple of years. And so I think we're going to see, I think 13, 14, and 15 are going to be very active as a lot of this money gets invested away. And then here's the next one that I think is really important because it's somebody who, originally, some of my early stuff that I was interested in when I was a young faculty member at Rice was what's going on in the IPO market. And the IPO market, I was always interested because I thought, this is really critical. So we've got to that's the only place where new money's coming into new companies. Everything else, that's going to generate growth. Everything else is just secondary trades. Well, last year, 2012, new money, 2 companies raised in the public market in the form of initial public offerings, $35 billion. 10% of what the private equity market did for you. Okay, so think about that. To me, that's phenomenal because the private equity market didn't exist 20 years ago. If we were just trying to live off the ability of new companies to go public and raise money in the public marketplace to get the economy growing, that's not an efficient economy providing capital to people that can create things and grow. But private equity is able to do that, and they're able to do it relatively efficiently because I think, if you look at what's an initial public offering, 7% gross spread, and probably fees and expenses. Bill, you've probably done one of these more recently than I have. But the cost of raising money in the public marketplace is pretty doggone expensive. We're getting to where raising public, capital in the private marketplace, heck of a lot less expensive than that on the transaction cost side. And then very quickly, you can see the role that they play here because a huge chunk of those companies that are going public are going to the public hands out of private equity portfolios. And so they're also channeling many companies into that IPO marketplace. And interestingly, you can see them very active in 11 and 12 because the window finally opened up again. They had portfolio companies they were looking to get into the public market. And then this last piece is, interestingly enough, and this is also significant for us, we don't see them necessarily going public with the energy-related companies that they've invested, but it's the non-energy companies. So, bottom line for me, energy is a great place to be. Last time I had a slide that I showed you that was looking at, the price of a BTU in oil versus a BTU in gas. I haven't checked that. I think it's still, you can buy a natural gas BTU for about 1/6 of what an oil BTU costs. And if you think about that, what you really want is the heating power of those molecules. You don't really care if it comes in natural gas or oil. So that spread in the cost of energy, I'm telling you, it's still out there. It's still going to close. But that's why we're building pipelines. That's why we're going to build electric power plants. That's why a lot of manufacturing is going to run off natural gas if we can get them supplied with natural gas. I think it's a great story for Houston. It's great to be diversified.